Hi, and welcome back to the Food Fund, where we explore all things related to investing in food and beverage stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will definitely love this channel. In this video we will be doing an analysis of Dole and seeing if it would be a great addition to the Food Fund. Be sure to watch through the end of the video where I share my final thoughts on that. Now, let's go ahead and jump right in. Cue that amazing logo. Let's start with some background info on Dole. Dole was founded in 1851 by Amos Cook and Samuel Castle in Hawaii. Its namesake, James Dole, formed a failing pineapple company that was later acquired by Cook and Castle, who then renamed the company as Dole. Dole has twice been a public company, most recently IPOing in 2021 after merging with another producer, Total Produce. Today Dole is headquartered in Dublin, Ireland and is the largest fresh produce company in the world as a vertically integrated producer, packer, and distributor with over 100,000 acres of farmland. Now, let's view the price action. Starting with the 1-year chart, we see that Dole had a CAGR of about 32%. Zooming out to the 5-year chart, we see that Dole had a CAGR of -9% for the last 2 years. Dole price action has been pretty volatile. Now, let's take a look at the fundamentals. Gross margin is 7%. Dole is a food producer in a competitive industry, so this makes sense. Revenue has compounded at around 19% over the past 5 years and has reached nearly $9.3 billion most recently. The good revenue growth seems to have been driven by inflation, so it is unclear whether we can expect such growth going forward. Looking at free cash flow, we see a 38% CAGR over the last 5 years, while capex has increased at a CAGR of 31%. Dole has been spending a lot to maintain its infrastructure. Stock-based compensation is increasing at around a 60% CAGR but accounts for only 6% of free cash flow in the most recent trailing 12 months. Weighted average shares outstanding have been pretty stable since IPO, going from 95.2 million shares in 2021 to 95.1 million shares most recently. Stable share counts are good, but decreasing share counts are even better. Now let's view return on invested capital. Return on invested capital has fallen from 8.2% in 2018 to 5.7% in 2023. Though the return on invested capital has decreased over time, it seems to be returning to an improving trajectory. Another favored metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 0 days in 2018 to 11 days most recently, Dole has gotten comparatively less efficient managing inventory. However, since the IPO, cash conversion cycle is starting to improve. Last, let's explore Dole's debt. The net debt to EBITDA is fair at 3 and has been declining from a high of 7.2 in 2021. It seems that the company effectively used proceeds from the IPO to pay down debt. The fundamentals of Dole are fair, but is that enough to qualify it as a buy? In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Dole. It is a food company with a gross margin of 7%. Given that the company IPO'd in 2021, let's use data from 2021 onwards. The 2-year revenue per share CAGR is 6% and the 2-year free cash flow per share CAGR is 26%. Not bad. A return on invested capital of 6% is pretty low. Next, the cash conversion cycle of 11 days is not horrible, but I definitely prefer to see negative cash conversion cycle values. Concerning debt, a net debt to EBITDA of 3 means that Dole could pay off all of their debts with about 3 years of earnings. So from a fundamental standpoint, Dole is decent. Now let's switch our attention over to valuation. Dole is undervalued relative to the S&P 500 with a ratio of 0.5. The price to earnings growth, or PEG ratio, is 1, which means that Dole is fairly valued compared to its projected earnings growth. Dole's recent pullback may represent an opportunity. The company has solid revenue growth and rebounding cash conversion cycle. However, more time is needed to confirm that free cash flow and return on invested capital are stabilizing. In the meantime, this is going on the watch list. Many thanks for watching. What do you think about Dole and its huge capex spend? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.